Welcome to this explainer. Look, if you're an investor or property owner right now, your feed is probably just flooded with all these alarming headlines about taxes and long-term capital gains. Honestly, just take a deep breath. Today, we're going to cut through all that noise. We're going to dive deep into the LTCG impact, breaking down exactly how the old provisions map onto the new Income Tax Act of 2025 in detail. We'll look at the actual math, clear up the confusion, and make absolutely sure your portfolio is perfectly positioned for this transition. So, let's just tackle the elephant in the room right away. Those viral headlines screaming that LTCG relief is canceled. When the government announced no new relief for domestic equity, well, panic kind of set in, right? People immediately assumed taxes were skyrocketing or some sneaky new penalty was hiding in the fine print. But honestly, you can rest easy. The existing framework is staying right where it is. This whole 2025 Act is all about simplification. It's absolutely not about punishing investors. Your investments are completely safe. You just need to know how the current rules work so you can make smart moves, rather than, panic selling based on a news alert. Okay, let's actually look at the numbers. The government confirmed that the long-term capital gains tax remains rock steady at 12.5% for domestic equity, once you cross that 1.25 lakh rupee limit. Remember, if you hold an equity instrument for 12 months or more, boom, that qualifies as long-term, and under the current rules, which are rolling right along into the new system, you still get that sweet exemption of up to 1.25 lakhs on your equity LTCG for the financial year. Anything above that threshold, that's what gets taxed at the 12.5% rate. So this steady rate isn't some terrifying new threat. It's just the reality of the tax landscape, and it's something you can totally build into your long-term forecasting without breaking a sweat. Now, since you're all savvy investors, I know you already understand that we're focusing squarely on your capital gains. The actual cold, hard profit you make from selling an asset like shares, land, or a house. But as we move into this 2025 regime, understanding exactly how the government shields that specific profit is going to be your superpower. The new laws aren't reinventing what a capital gain is. They're just logically mapping out those gains and your exemptions so you can breeze through this transition seamlessly. Think of this shift to the 2025 Act like a massive, much-needed spring cleaning. The old 1961 Act, it served us well for over 6 decades, sure, but it had been patched up and amended literally hundreds of times. It turned into this massive, messy encyclopedia full of confusing cross-references that gave everyone a headache. The new Income Tax Act, kicking in on April 1st, 2026, is basically a sleek, modernized handbook. It doesn't radically change the underlying tax policy or slap you with a huge new tax burden. It just takes all the old provisions and reorganizes them, so the law is actually readable, logical, and way easier to comply with. And this is exactly what I mean by that. Your familiar reinvestment exemptions, they haven't vanished into thin air. They've just been given new name tags. For example, let's say you sell a residential house and you want to reinvest those capital gains into a new house to get tax relief. You used to rely on the famous Section 54, right? Well, under the new regime, you're just looking at Section 82. That's it. The exact same tax relief is right there waiting for you. The timelines to buy or build are absolutely identical. Even agricultural land exemptions just hopped over from Section 54B to Section 83. It is literally a direct translation of the old benefits you know and love, just with a much cleaner organizational structure. Now, let's talk about a rumor that's causing a lot of sleepless nights. So many taxpayers are completely panicking, thinking the capital gains account scheme, the CGAS, is dead and gone under the new rules. Well, I am here to calmly, officially reassure you it is fully retained to protect your money. Honestly, this is probably the single biggest misconception floating around out there right now. The CGAS is your ultimate safety net. Normally, if you sell an asset but you haven't bought your replacement property before your ITR is due, you'd lose your exemption. But the government totally gets this, and they've officially confirmed that the CGAS continues to operate seamlessly under the 2025 regime to preserve your hard-earned exemptions. It all comes down to a very specific choreography. It goes like this. Once you sell, the clock immediately starts ticking. If tax filing season rolls around and you still haven't bought that new house, no problem. You simply park those unutilized funds in a CGAS account at an authorized bank before your deadline hits. Doing this essentially hits the pause button on the clock. It gives you a statutory grace period, which is 2 years to buy a new house, or 3 years to build one from scratch to use those funds. If you just follow these steps and keep a close eye on your calendar, your tax exemption stays perfectly intact under the new act. Let's actually map this out with some real numbers. Say a 40 lakh rupee gain.
If you deposit that 40 lakh into a CGAS account, but that 3-year timeline expires and you haven't built a house, the status of that money flips. Under the new rules, for instance, if you sold your property in July 2026, your absolute deadline is July 2029. If you default and don't use the funds, boom. That entire 40 lakh becomes fully taxable under the new 2025 Act in that specific tax year. So the mathematical timeline works exactly like the old system, but the assessment year aligns perfectly with the exact moment your statutory grace period runs out.
Now, what if you're caught right in the middle? Well, the Section 536 transition rule seamlessly bridges the two laws. Just imagine you sold a property back in June 2024, so under the old act, and you safely chucked that money into a CGS account. Then, the shiny new 2025 Act kicks in during April 2026. If you slip up and fail to use that money by your June 2027 deadline, what happens? The tax authorities will actually look back at the old, repealed Section 54 rules to check if you complied, but they're going to charge and collect the actual tax penalty under the new 2025 Act. It's an incredibly clean handoff between the two systems. But guys, you absolutely must be aware of this 3-year trap. I'm serious. Forgetting this deadline is practically a guaranteed way to suddenly owe a massive amount of tax to the government. We see this compliance disaster all the time. Taxpayers diligently put their money into a capital gains account. Life gets super busy and they just forget about it. If that 3-year construction limit comes and goes and those funds are still just sitting there unutilized, your exemption is completely withdrawn, like instantly. That money becomes fully taxable in the year the limit expires, and trust me, the tax department is very, very good at tracking this exact transition. Which brings us to another major source of financial anxiety this season. Beyond just missing CGAS timelines, why on earth are so many taxpayers suddenly getting income tax notices? I know opening one of those is a massive pain point for retail investors right now, but I let you in on a little secret. Most of the time, it's not because you're intentionally trying to evade taxes. It almost always boils down to a simple, frustrating data mismatch. Basically, the information you typed into your return didn't perfectly match the mountain of data the government already has on your financial life. So let's look at exactly what triggers these automated red flags. Basically, there are 5 deadly traps that set off these red flags. The first 2 are all about data, literally ignoring your broker's capital gains statement and failing to verify your annual information statement, or AIS. The other 3, they're timeline and reporting failures. Things like forgetting to report that unutilized CGAS balance when the 3-year trap springs, or missing your deposit deadline right before filing your ITR, or just keeping really sloppy acquisition records. Honestly, making any of these missteps practically guarantees you're getting a notice in the mail. So how do you protect yourself? You have to perfectly reconcile your personal broker statements with the government's official AIS records before you ever hit submit on your return. Think of your AIS as the government's ultimate master ledger of your financial life. The tax department uses AI to automatically match your submitted return against this exact ledger. If your broker says you made a 50,000 rupee gain, but your AIS shows something else, or if you report a totally different number on your ITR, bam, the system flags it instantly. You absolutely have to compare the sale consideration and acquisition cost on your broker's statement against the AIS. Find a mismatch from a corporate buyback or a dividend? Fix it before you file. As we wrap up this explainer, I really want to leave you with a golden rule to live by. Focus on the fundamental strength of your investments and just treat taxes as a cost of doing business. It is so incredibly easy to let the tax tail wag the investment dog, you know? People hear no LTCG relief, and their first instinct is to stop investing entirely. But real professional investors, they look at business quality, long-term growth, and risk tolerance first. They aim to earn those strong returns, and then they use the rules, like Section 82 and the capital gains account scheme, to legally optimize their taxes. Tax is just one factor. It's never the entire equation. Well, thanks for watching. Please like, share, subscribe, and comment. We will meet in next video in part 2. But before you go, I want you to ask yourself a serious question. Are your current investment records perfectly clean enough to survive an AI data match against your AIS tomorrow? Think about that. Get those documents organized, and I'll see you next time.